This is Danny Gould with the Selling Silicon Valley Group. Welcome everyone to another Silicon Valley market snapshot for the fourth week here in March of 2020. The coronavirus situation has escalated very quickly over the last week. Obviously, when we shot the video last week, shelter in place had just been enacted here in Santa Clara County, and then subsequently it got enacted statewide. Now it seems like almost every state in the US is on some sort of lockdown. And so what I wanted to cover today was the effects of the coronavirus, or the effects of the coronavirus and its potential ability to decimate the housing market, or whether or not the housing market is going to weather this storm. So I want to give the negative and the affirmative cases on both sides of the spectrum to give you guys a total outlook on the situation here, because the situation is so fluid right now that it's really hard to predict with, or really hard really to give with any degree of certainty a definitive viewpoint at this point as to what's going to happen or how this situation is going to unfold and play out. But we can definitely look at some predictors, some lead metrics, if you will, and look back at historical data, historical trends, and see if we can establish any sort of patterns to predict what could potentially happen here in Silicon Valley and nationwide as well. But we really want to focus the conversation today on Silicon Valley and how it's going to how COVID-19 is going to impact the real estate market, not just in the short term, but in the long term as well. So by the way, everyone, I have come down with a very severe case of quarantine hair. And so I'm, for the foreseeable future, going to be doing all of my videos, Zoom calls, everything in my Selling Silicon Valley hat. I had a barber appointment 2 days after shelter in place was enacted, and I'm regretting it. I'm really regretting not getting my hair cut beforehand. But anyways, I digress. Enough of that. I hope all of you are staying healthy and safe through all of this. It is definitely a trying time for us, and I want to make sure that you guys understand. I'm giving all this information and we're talking here, but the most important thing is that we remember that the reason this is happening is because we're trying to save lives, and that takes precedence over everything else. And so I want to make sure that you guys understand that that's that's the underlying message, in all of this. But how is this going to impact the real estate market? And I've been getting that question a lot. And so will this cause, or will this be the demise of real estate here in Silicon Valley? Will COVID-19 be the demise? And if you guys have been watching my videos for any period of time, you'll know that I, for many years now, have predicted that it will take some sort of extraneous force, some external factor, to impact significantly, to have a significant impact, negative impact on Silicon Valley home prices. And here we are with the first real extraneous factor that no one could have predicted. A coronavirus, even 6 months ago, no one had any idea that this was going to happen, and this is the sort of thing that could derail the housing market. And many, some experts are of the opinion that that's going to happen. And so when we look at economic, the basic economic principle of supply and demand, what's going to cause supply to increase drastically or demand to get reduced drastically for it to have a negative impact on the housing market? Well, clearly we've seen over the last 2 weeks the stock market people's portfolios have been decimated over the last 2 weeks. And so if you look at Silicon Valley and you look at the home buyers here, the majority of them have quite a bit of money tied up into the stock market. And so could that have an impact on buyers' willingness to buy or ability to buy? From what I've seen so far, and this could change, but from what I've seen so far, there are a subset of buyers who are now out of the race. There are buyers who are pulling out of transactions right now because their portfolios have been decimated, and there are buyers who are just flat out now not going to be coming into the market because the majority of their down payment was coming from stocks, and that is not surprising, right? I think if you have half a brain, you'll understand why that is. However, Their willingness to buy is not necessarily being at least at this point hindered. At least many buyers here in Silicon Valley. I've actually had in the last week 3 Zoom conferences with 3 different buyers that want to buy immediately after shelter in place is removed, and that to me, I can't remember the last time where I had 3 buyer consults that were that ready to go in 1 week's time. And so what that tells me, and that's just me personally, not including my team, but what that tells me is that there is a subset of buyers out there that although, and all 3 of them had positions in the stock market, all 3 of them, although they had slight hindrances through their, or a drop in their portfolio, they still have enough set aside for their down payment so that their down payment wasn't necessarily impacted, and so they're still willing to buy at this point. And they see the security of real estate, and they're realizing now more than ever is a good time to double down on an asset that is more secure than leaving it in the hands of other people, right? Real estate is really one of the only things that you have direct influence and control over all of your positions, right? So, what could cause the housing market to take a huge hit here in Silicon Valley? Number 1 is demand, lack of demand due to buyers' stock portfolios being decimated. The other is simply the uncertainty and the fear that comes along with this type of situation, right? Obviously, coronavirus is new. This is a new thing for not just for Silicon Valley, but for United States as a whole. And so I think when you look at some home buyers, their uncertainty and their fear will take over, and they will choose to sit it out to try and regain some of that confidence. The problem is that once they regain that confidence, the rest of the market will have as well, and then prices will be back to where they are if they do drop. And so you'll also have the opportunist buyers, the ones that wait it out because they want to see if the market drops. So you will see a subset of buyers drop out for sure. And I don't think that should surprise anyone. But the question is, will there be more buyers that drop out than sellers that drop out? And that's really the main question here. If you watched my video last week, you'll know that when I talked about potential rise in supply, the predominant rise in supply could be coming from the baby boomers that are left with half the portfolio that they had 4 weeks ago. And when they're looking at their runway here in Silicon Valley, they realize that they really don't have the ability to stay here for much longer. I mean, if you think of the prototypical Silicon Valley homeowner right now, they're a baby boomer that's close to a retirement age, if not already retired. They've worked up to this point for the last 5 years or so, non-essential jobs, or they're retired. And so now their income is completely gone, if it wasn't gone already. And when they when faced with the harsh reality that they may not have enough savings right now, because we do know that a lot of baby boomers in this area do not have, they are cash poor but equity rich, and so when they look at their runway here in Silicon Valley, it's sad to think about, and I hate talking about this, but it needs to be it needs to be discussed. Those baby boomers could very well, in fact, cause a surge in inventory simply because the market and the pressures of being here and the pressures of the market's collapse essentially over the last 2 or 3 weeks will cause them to act and to have to act all at once. And so we could see a rise in inventory because of that. Keep in mind, though, that there have been stimulus, there are moratoriums in place on foreclosures and evictions and all that passed by the government. And so for the next 60 days, I believe, no foreclosures can happen. And so we're not really in a foreclosure market right now. There aren't that many foreclosures happening right now. And because people in Silicon Valley are so equity rich, it's really hard to fathom a situation in which we see a slew of foreclosures flood the market, because for the most part, Silicon Valley homeowners have plenty of equity to fall back on. And so a really interesting statistic that I wanted to share with all of you right here is, let's see, this one right here. The total home equity cashed out. I've crumpled these papers. It's a nervous habit. But if you look, total home equity cashed out by refinance in billions. So one of the arguments that I've heard for homeowners needing to sell is that they've completely tapped out their equity. But if you look at the refi volume right before the housing crisis in 2008, we had a total of 824 billion refinanced, home equity refinance in 2008 total, 824 billion. And right now we only have 232 billion. So we basically have, 30% of what we had cashed out in 2008 right now. And so while people definitely have taken advantage of the equity, that they've made, they haven't refied to the point where they've over leveraged themselves. At least that initially nationwide seems to be the case. Is that different here in Silicon Valley? The reality is I don't know. Probably not the best person to ask. If someone's watching this video and they have statistics or data on what the total refi volume is right now, or how much equity is being tapped into here in Silicon Valley, I'd love to see that information, because it would give us a better idea of what to expect. But this is a predictor of an economic or of a housing crisis, right? And this number is less less frightening, right? So I think we're in a position right now where there's definitely arguments to be made as to why the housing market could collapse. But what I want to focus on right now is why it might not, and why we might weather this storm as one of the strongest marketplaces in the United States. From a demand perspective, I truly feel that the Silicon Valley economy is better positioned to weather this storm than almost any other marketplace in the world. And that's because our economy is comprised of mostly tech companies that have access to the consumer in ways that almost no other industry has. When you look at, most of the companies in Silicon Valley have virtual access to the consumer, or direct access to the consumer, to the point where there's no human interaction that even needs to take place. And as a result, the jobs here are so secure. I mean, you'd be hard pressed to find another area where people are totally used to working from home. But like the vast majority of the tech workers, or the workers here in Silicon Valley, have at some point in time been, worked from home. It's just a part of the culture here in Silicon Valley, and it's something that it's something that other industries just don't have the luxury. So whereas many manual or manual labor industries, or industries that have a lot of human interaction, right? Those industries are going to be hit a lot harder. But the vast majority of our economy is enabled by these companies that have direct access to the consumer in ways that most other industries just simply don't. And so the job security here, I do believe, is significantly higher. And so that will help us weather this in some way, shape, or form, simply because buyer demand will continue to be there, because jobs are still here, luckily, right? And so I do believe that we're better equipped, or better positioned, to weather this storm from a demand perspective. Also keep in mind that from brain fart. From a supply perspective, we might see for the foreseeable future sellers having difficulty dipping their toe back into the water once shelter in place is removed. And so because there are a lot of buyers right now, they're sitting on their couches, all they're doing is they're looking at Zillow and Redfin and all the other websites, and they're house shopping online. And so I do believe that that will keep buyers hot. Sellers may have more difficulty dipping their toe back in and taking that chance, especially if the sellers are elderly. You know, we just talked about, a good, the vast majority of homeowners here in Silicon Valley being that baby boomer generation. Unfortunately, due to the nature of coronavirus, it impacts that community the most from a health risk perspective. And so those sellers or those homeowners opening up their home to buyers may not be the best course of action for them at this point from a health perspective. And so a lot of them may choose to hold their home off the market until coronavirus has completely died down, the hysteria has died down, and the health department, the CDC has given their blessing for people 65 and older to resume, or 60 and older really, to resume their normal daily activities. I don't think that's going to happen when shelter in place is removed. I think that you're going to get that blessing significantly after shelter in place is removed. So there's going to be a period of time where inventory levels might be suppressed because of the health concerns associated with putting your home on the market. But once that is no longer in effect, or once that's no longer an issue, do we see a flood of inventory, or do we see inventory flood the market at that point from all the suppression that's happened over the last 3, 6, 9, however many months? I do believe this though. The longer shelter in place is in effect, the more of an impact it will have, the more of a negative impact it will have, not just on the economy, but on the housing market. Because right now, real estate is at a standstill. And the reality is that for the foreseeable future, it's infinitely more difficult to sell a home in this environment. Buyers are not used to seeing homes sight unseen. And even though they can write into the contract that they will see the home after shelter in place is removed, well, if shelter in place is removed in 3 months, which I don't think is going to be the case, but if it is removed in 3 months, I mean, that's 3 months of homes not selling, period. Homes not closing. Right? Homes going pending, but not closing. And the visibility and the ability for buyers to get into homes is practically non-existent at this point. It's actually illegal for buyers to go see a house at this point. So how, if the rules get changed or manipulated in some way, shape, or form to allow buyers, or they become, the rules become more lax at some point in time, then that could open, that could be an opening or an opportunity for the real estate market to regain some normalcy, and for deals and transactions to actually happen. Because right now we're kind of at a standstill. If you didn't get most of the way through the contract before shelter in place was enacted, chances are you're at a standstill right now, and things aren't going to close until after shelter in place is removed. So a couple more things that I wanted to share with you before we end today. I know we're going way over. I've shared this slide before, but I wanted to remind all of you that three out of the last 5 recessions, housing has appreciated here nationally. In 1980, 1981, we had 6.1% appreciation, 3.5% appreciation in home prices nationally. In 91, a slight decrease. In 2001, we had a 6.6% increase. And of course, we all remember 2008 because it was the last one. It's the freshest in our memory. The housing crisis caused the economic collapse that time. And if you look at that and what that did to the S&P corrected 51% over the course of 2 years, right, from 2007 to 2009. In those 3 years, rather, we had negative 4.6, negative 10, and negative 4.1% decrease in housing prices. But when you compare that to the dot-com crisis in 9/11, practically the same correction in the S&P 500 over those 3 years. But if you look at what happened to home prices, they appreciated every single year, 8.6%, 6.6%, and 8.5% over those 3 years. And so this should be a good sign, because this, my goodness, I'm getting all my stuff. This was an inside job. This was a result of the housing crisis was a result of poor lending practices. This was an outside job. These were extraneous factors that caused the market to correct, the stock market to correct. Notice the stock market the depreciation in the stock market did not dictate what happened in the housing market. People turn to, in times of uncertainty in the stock market, to the certainty and the security that is real estate. So that right there should be reassuring to anyone that has, large positions in the real estate market here that they plan on selling in the next 12 to 24 months. Obviously, it's reassuring to know that happened, but just because that happened before doesn't necessarily mean it's going to happen again. History tends to repeat itself, though. And so if you look at the historical trends and you look at what's happened in real estate before, I do believe that we're going to be more along the lines of what happened in 2001 as opposed to what happened in 2008. A couple more things to share with you. Wells Fargo Investment Institute says we do not expect a repeat of the severe recession of 2008 because the virus and oil shocks are not endemic to the financial system, but are rather external. Exactly what I just said right now, right? Once the virus infection rate peaks, we expect a recovery to gain momentum into the final quarter of the year and especially into 2021. That was on March 17th. So just a week ago. Goldman Sachs GDP forecasts, guys, Q2 decimation, but then a quick and fast recovery in Q3 and Q4. Obviously, I'm an eternal optimist. I'm gonna say right here, I hope that happens for all of our sakes, but we need to be prepared for the worst. And so obviously, while my team is sitting here and we're eternally optimistic that everything's going to go great, we're also prepared to take on the market in whatever condition we find it in once we come out of the shelter in place. This is Danny Gould, everyone, with the Selling Silicon Valley Group. Have any questions, comments, leave them down below. I'm more than happy to chat with you. I got all day now. I'll catch you guys in the next video.